Fleets continue to have ample opportunities to hire as drivers remain highly active in searching for new driving jobs. If current trends continue, we could be headed for the lowest truck utilization rate since all the way back in 2015. Another CVSA road check event is rapidly approaching, and California becomes the first government in the world to mandate all electric trucks. Plus, we'll check in with Jason Miller for this month's Economic Outlook. All that and more straight ahead. For the 30-Day Reset, I'm Joshua Miller. Welcome to the latest edition of the 30-Day Reset. Before we jump in today, I just want to point out that we will be covering a lot of ground. I'll do my best to provide an accurate snapshot of where we're at the moment, but everything I go over today and more is covered in detail in our 30-Day Reset PDF. Links to the articles going more in depth on the news stories and charts and graphs covering the recruiting topics, as well as the data provided by our economic guru, Jason Miller, are all there for you to dig into. So if you're not already, I encourage you to take advantage of that. Link found down below. With all that said, let's get to it. First up, trucking by the numbers, brought to you by Stratus Strategize. Let's dive right in and take a look at driver trends. Click costs are falling and conversion rates on CDLA recruiting landing pages are at their highest point on record, while the number of truck driver jobs posted in February was at its lowest point since July of 2020. Those low click costs combined with record-breaking conversion rates are effectively driving lead costs down. March's overall average CPL is on pace to drop to the lowest level since June 2020, and all the track driver types are on pace to fall by between 13 and 17% month over month. Click costs dropped for both active and passive advertising channels. A 5% month-over-month drop for passive channels suggests there is currently less competition in the market from advertisers, while a 9% drop for search CPC indicates the supply of advertising for driver jobs is decreasing in comparison to the number of drivers actually seeking new jobs. After seeing costs increase in February, March's overall average cost per lead is on pace to drop to its lowest level in almost 3 years. The number of available driving jobs has continued to drop faster than the number of drivers looking for these jobs, creating favorable opportunities for carriers looking to hire. The hiring costs for February followed seasonal trends and remained far behind the average CPH of last February. Cost per hire for owner-operators is now down 50% year over year, and lead to hire improved by 14%. That's the second best value on record. This means it's a very good time for carriers to partner up with owner-ops, as these drivers are now looking to mitigate load and rate uncertainty. Now for the freight side of the equation, FTR does not expect conditions to turn positive for carriers until September of 2024. The weak economic data for Q4 2022 and downward revisions in industrial production data led to a substantial reduction in the truck loadings outlook for this year. The weakening truck loadings forecast, coupled with recent capacity gains, has also caused FTR's truck utilization forecast to drop. They project it will bottom out in Q4 of this year at 84%. That's 2.5 points below the previous forecast. If this prediction does come true, that number would be the lowest utilization since Q4 of 2015. Overall load postings were down a little over 0.5% week over week, and that number registers 53% below the same week last year and is trending 27% below the 5-year average. For individual segments, we saw dry van loads increase by 3.7%, refrigerated also rose by 1.7%, and flatbed loads declined by 4.5% week over week. Total broker posted spot rates increased by just a fraction of a cent, and that now makes 3 consecutive weeks that this has been the case. Total market rate was 22% below the same week of last year, but up by 1% when compared to the 5-year average. Dry van and flatbed rates both fell by 4 and 7 cents respectively, while flatbed rates increased by 3 cents per mile week over week. Now, our top headlines. First up, it's that time of year again. Another Commercial Vehicle Safety Alliance Road Check event is headed our way. During the road check event in May of last year, inspectors conducted 59,026 inspections and placed 12,456 vehicles and 3,714 drivers out of service based on those inspections. This year's campaign is slated to take place May 16th to 18th with an emphasis placed on anti-lock braking systems and cargo securement. So, if you want to avoid the hassle of trucks and/or drivers being removed from service, consider yourselves warned. And finally, California becomes the first government in the country, scratch that, the world, to mandate electric trucks. The state will require truck manufacturers to accelerate sales of zero-emission vehicles, or ZEVs, in the state with increasing standards from 2024 to 2035. Massachusetts, New Jersey, New York, Oregon, Washington, and Vermont are all also likely to adopt the standards being pushed in California. Together, these states represent 22% of the national truck market. The EPA approved the Clean Air Act waivers for California's heavy-duty truck regulations, including requiring truck manufacturers to increase zero-emission semi-tractor sales to 40% by 2035 and mandating all heavy-duty vehicles, wherever possible, be zero emissions by 2045. President and owner, Independent Drivers Association, Todd Spencer, had this to say in reaction to the news. This is another example of California approving onerous regulations that increase operating costs for truckers within the state. He went on to say, "We have yet to see proof that electric CMVs are a realistic option for most trucking businesses, considering the price tag and lack of charging infrastructure. Bottom line is that the technology they are trying to mandate does not yet exist." And that's it for the top headlines. Now let's check in with our good buddy Jason Miller for this month's Economic Outlook.
What we're going to talk about today is the recent data that has come out on the trucking sector in terms of employment for March and trying to understand what is going on. So for February, we saw a fairly sharp decline of trucking employment, both seasonally adjusted and not seasonally adjusted. What that was indicating was carriers lost payrolls, and more so than was expected by the Bureau of Labor Statistics. This didn't surprise many of us, given that we've been in a freight recession really since the third quarter of 2022. However, what was surprising is March's data, while being preliminary, is suggesting an increase in trucking payrolls, more so than was expected. So we saw an addition of about 3,600 payrolls in the trucking sector in March of 23 from February of 23. And that increase, while certainly less than what we saw in, let's say, 2018 or 2021 during very strong bear market cycles, that number is actually much more than we saw in March of 2019, and even interestingly enough, March of 2022, which is very surprising. It surprises me that we saw payrolls increase. And so really that brings the question of what could possibly be going on to explain this. And I'm just going to throw out one idea to maybe help reconcile what's going on. And that is the need to recognize that across all of trucking, which is a very broad industry sector, we're covering local dump trucks moving, bulk aggregates. We're covering, specialized carriers hauling acids long distances. We're covering flatbed. We're covering refrigerated. We're covering short haul truckload operations very much needed for manufacturing or mining activity. When we look at all of trucking, prices that carriers are receiving for their services are still elevated 28.3% from before COVID. Now, yes, a good chunk of that is due to fuel surcharges, but some share of that is due to real increases in dollars per mile that are being received across all of trucking. And actually, year over year, as of February, for all of trucking, those rates are actually flat. But that flat year over year is disguising very different dynamics we're seeing right now within sectors. What we think would correspond to that dry van over the road sector in government data, rates there are down 12% year over year, which is very indicative of the cooling market. However, if we look at sectors like specialized carriers that are hauling acids and things like that, rates are actually up year over year, about 6-7% right now. Local dump truck carriers, their rates are up year over year. Local dry van activity, rates are still essentially up a few percent year over year. And so one thing I would say is I think what we're seeing in the employment data is the fact that for other sectors of trucking, we're not seeing rates decline nearly as much as we've seen in that dry van over the road segment. That may be one reason the carriers are adding payrolls. Unfortunately, we don't have the detailed March data yet to ascertain which sectors actually saw employment gains, but that'll be something we'll want to be looking at very closely for next month. And so with that, that wraps up my comments for the current state of the economic conditions in trucking.
As always, that's some really great stuff. And as a reminder, you can download the charts containing the data Jason was referencing, as well as all of the other stuff covered in today's show in the link below. The download features all of the numbers and goes into even more detail than we're able to do here on the show. Well, that'll do it for this month. We hope you'll come back and see us next time for another 30-day reset. Until then, thanks for watching.